Today, I'm going to share with you a very powerful tool that every trader should have in his box. I'm going to show you how to use volume to identify a breakout in a stock. Now, it's enormously important because you have to remember that your job as a trader is not just to generate above average returns. Your job is to do so as quickly as possible. If you buy a stock at 10 and sell it at 20, but it took 3 years to get there, that's just an okay return. If it did the same thing in 3 months, that's a fantastic return. That's where breakouts come in. Now let's go to the chart. I'm going to walk you through a live example. This is a chart of a stock called Repligen, ticker symbol RGEN, and it's one that has shown several sort of picture-perfect breakouts over its lifespan. Now, there are two key components to any breakout, the base and the breakout. Now, the base is an area, I often refer to this as price acceptance. It just looks like choppiness, but when a stock is consolidating for several weeks, preferably several months, in a key area and has clearly defined resistance. And in our case, the base I'm referring to is right here on this chart. So here are the characteristics of a base. You should have clearly defined resistance, meaning a line across the top that the stock cannot break above. In our case, it's going to be right up here. Right up here around $39 a share. Can you see that? It's not breaking out there. It's stopping at 38, 38, 38 and a half, 39. That's our resistance level. Now, the other thing you want to look for in a properly formed base is a decreasing of volatility. And to put this in layman's terms, you want these little dips to be shallower and shallower and shallower. Okay, here's what happens in a base. Here's why bases form. Bases form when large money is building positions in a stock. If you're Goldman Sachs and you're trying to build a $800 million position in the stock, you can't just go shoot a market order into your E-Trade account. You got to get your traders on the floor to represent only a certain percentage of the volume, is not to move the stock, and you do so over several weeks. This is also when the stock trades hands from the weak hands to the strong hands. You'll hear that term if you're hanging around the finance world a lot. Weak hands are honestly me and you and all of us who are just trying to trade a stock, right? We may have a stop loss that's 10, 15, 20% away from the thing, but we're not trying to build a monster position in a stock we're going to hold for 10 years. Strong hands, those that aren't working stops. They're putting a lot of money into it. They're going to hold it no matter what, and they're looking to hold that position for a lot of time. And so what happens is these swings, the downside swings, shake out the weak hands and consolidate into the strong hands. What you should see are these becoming shallower and shallower and shallower. And I've gone ahead and mapped these for you. And here's what those numbers are on those four dips. I'm going to take this rectangle off the chart. We know where our base is now. But look at these. Look at the decrease in the movements. We had a 21% dip, then about 8.5, 9 about the same. It's getting shallower, 6, shallower, shallower, shallower. And then right up before the breakout, look at the volume down here at the bottom. You want to see two things. The first is you want to see a decreasing of the volume. Now, it's never going to look picture perfect, but for the most part, with a couple of exceptions here, we were seeing this. Okay, so do you see how the volume was sort of decreasing there? There's a couple of days going to break out above it, but overall, it's getting lower and lower and lower and lower. And then right in the days before it, like these last 2 days before it, volume should be almost anemic. I mean, almost non-existent right there, at half or a third of what it has been on average. So you want to see decreasing volume. You want to see decreasing dips on here, and then you're looking for the breakout. Okay, now, look, this stock ran to $70 a share. Okay? Now, had you bought it back here when it first dropped around $40 and ran it up there to 70, you'd have made a nice little return, 70, 75% on your money, something like that, right? But it would have taken you over a year to do so. Wouldn't it have been better to have your money working somewhere or generating return during all this choppiness and you knowing to buy it right there? Same buy point, still in at $40, still riding up to 70, same percentage return, but you're doing so in less than half the time. That's the power of using these breakouts. So let's continue with our lesson. We've got our base. All right. We've got shallower and shallower dips, meaning decreasing volatility. We've got clearly defined resistance here at $39. We've got decreasing volume in the daily below. And then we get our breakout day. Now, here's what you want to look for in a breakout. One, and most importantly, is you want it to do so on above average volume. You want a volume candle like this on the breakout day. Okay, it should be double, triple, 4 times the average daily volume of the stock. You want to see the stock also break above your resistance level and close above it. Okay, you don't want a little head fake. You don't want to, it popped up here but came right back down by the end of the day. You wanted to close above it. So it did so, and it closed the day up here at 40.5. So that would be your buy point. You'd buy this, either buy it while it's breaking out if you feel good about it, or wait, make sure it closes and buy the next day right here at 40.5. All right, that's what you'd be in the stock. That's a textbook breakout. And then look how nicely the stock trends higher after. Now, when a stock forms a base and breaks out, you will usually see several more bases along the way. And it's just because it's just market behavior. When a stock makes a big move higher, people are going to take profits, and that's going to cause the stock to pull back a little bit before continuing its run higher. On average, a good breakout, you should see 2 to 3 bases, maybe 4. Is textbook of a good solid breakout. So if you see one happen, don't chase it, don't hop in, wait for the next base, the next breakout. But if you're seeing you're on the 3rd, even the 4th base, you're kind of running on borrowed time. So blur a couple of these out. I'll put our new numbers back on. And we'll show you what we're looking at with this one. So in this chart, delete some of these, we had 3 bases form. Okay, we had our first one back here, which we just analyzed and looked at this breakout. So the stock gets in here, breaks out, runs up, and then forms another base right here. Okay, same as before, just sideways action, clearly defined resistance above the top there, shallower and shallower pullbacks, decreasing volume, and then a breakout. This one didn't have huge volume on the breakout, but 2 days after it did, a breakout above that. So that's the second base. And then we even formed a third one up here. And again, this is simply accumulation distribution. Okay, when a bunch of people buy a stock at 40, it runs to 50. Some folks are going to take profits. It is normal to have these little pullbacks through there. And it's going to push back higher, another pullback, another push higher, and then the thing really just kind of collapsed down here. But let's look at this third breakout. I've run the numbers on this one as well. Not quite as textbook as the other. You'll often see this. You'll see shallower, 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 and then a little head fake right here at the end you'll see sometimes. Okay, but don't let that scare you out of it because everything else looks good. Our volume was somewhat decreasing as we got toward the end. Look at these last couple of days here on the chart. I mean, look at these tiny little volume candles there and the one there. See how tiny those are? Almost no volume on these last couple of days leading up before the breakout. And then boom, huge breakout candle, big volume, closed above our area and started pushing higher. This one didn't last very long, but again, that's because we're on like the third base. Okay. So that's the two components, the base and the breakout. That's what you're looking for. And again, if you missed the first one, wait for the second. If you're in from the bottom, you have to expect these things. All right, you have to say, you know what? I understand it's not going to go straight up forever. I mean, between May and June, you'd be getting really spoiled in this beautiful little trend we had going on right here. It doesn't get much better than that. And then when it goes sideways, you think you made a mistake. But you have to understand these bases happen. There's going to be profit taking before the run's higher. So that's the basics of identifying breakouts using volume and how to ride them higher. Now, in the next video, we're going to go over when to sell. It's always nice to get into a stock and see it trend higher. But again, there's nothing worse than being up 50, 60, 70% on a stock and then letting that turn into a loss. You need to have a plan as soon as you go in on when you're going to sell that stock and what you're going to look for that would trigger you to exit the position. So watch for part 2, and I'll show you where to sell.